Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Debt Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch.
Hello, everyone. It looked for a couple of days earlier this past week that markets were starting to settle in, that market interest rate volatility was starting to lessen a bit. A lot of the volatility we saw through October made it through that week to where we had the week of the RBA and the Bank of England and the Fed. Those central banks did not meet what was overly hawkish market expectations. We can argue about whether they were particularly hawkish or dovish, each one, but clearly markets have gone too far, and those central bank results caused not just volatility in the rate market to come down, but actually yields to start to retrace to some degree. But that was until this past Wednesday when the US CPI came out, and it was again much stronger than expected. But it wasn't just stronger than expected on its own. The report showed broad-based strength across many categories, not just supply chain related issues like used cars or some of the COVID reopening issues that had boosted CPI and inflation in general throughout the summer, but it was strength across the board. And so this was a concern for markets, and again started to push market interest rates higher, led by US Treasuries, to where we got to basically the high yields that we saw at the height of all of the volatility in October and into that first week in November when we had these central bank meetings. Though I should note this was really led by US Treasuries on Wednesday, a little bit less into the Anglo economies, and European yields did not move as much as the others, with a very different kind of central bank reaction function in the background. In addition to the yield moves, the dollar strengthened, and this is something that is a little bit different than the volatility in October, where both FX and risk markets took higher yields in stride. And while we're still basically at the highs in equities, we did see a bit of a retracement off the highs on strong inflation data as the markets push US yields back to their earlier October highs, and within that priced in a higher probability of Fed hikes down the road. So there's a couple things to actually follow up on here, and I have Brian Daingerfield, our co-head of G10 FX strategy, joining me for that. So Brian, first off the bat, is it time for volatility to return to the FX market, and to have worries about the Fed or market expectations for the Fed come to the point where you think we might start to see more of a broader, strong dollar trend?
So certainly from an FX perspective, the volatility in FX markets has been relatively low, especially compared to interest rate markets. We've seen, you mentioned the last couple of weeks, really the final weeks of October were very significant from a central bank perspective. You saw very, very hawkish surprises from some central banks, the Bank of Canada, for example, and others delivered quite dovish responses. And we've really seen significant movements in interest rate markets that have not really followed up that significantly in foreign exchange markets. You see currencies, generally speaking, you would say are well behaved relative to the major volatility in rates markets. And you could say the same for commodities. You've seen significant moves in commodities, and commodity linked currencies have really not risen in tandem with those moves. And so wider market volatility has picked up, particularly in the rate space. FX volatility has stayed low. And as long as we have inflation uncertainty leading to central bank uncertainty, and with it interest rate uncertainty, that's something that can drive FX volatility to move higher as well.
So shifting gears a little bit, we've been spending a ton of focus in the last few weeks on monetary policy, and rightly so. But there's also this underlying current where some of the fiscal policy we've had previously may be contributing to the strong demand, and it's not just a supply story that's rising inflation, but you have a lower supply curve, but demand is actually rising because a lot of the fiscal policy impulses we've seen out of COVID and really into the reopening. So tell me about what's going on in fiscal policy in the US lately. What's the status of these two bills that the Democratic Party has been working on for such a long time?
Well, we can happily say, I guess, for the Democrats, the first one is essentially done. The larger partisan bill is still facing some hangups, and I think the CPI number might have hurt the chances of that bill becoming law in the very near term. So taking a step back for a second, in early November, Democrats performed pretty poorly across the board in this cycle of elections. And now this is consistent with a wider trend where the party who sweeps into power in a presidential election tends to do very poorly in the next cycle's elections. The most obvious example was Democrats lost the governor race in Virginia, a state where Trump was honestly dominated by President Biden just 12 months ago. So this is the kind of loss that's not uncommon in US history, but it's one that I think really spooked Democrats in an environment where Joe Biden's approval rating has been steadily falling. And that's something that I think really helped motivate Democrats to get at least a bipartisan infrastructure deal over the finish line. So if you recall, that 1.2 trillion headline bill, which is really 550 billion in new spending, had passed the Senate in July and was sitting in the House essentially stagnant all the way through the beginning of November. And Democrats might consider that as a mistake in hindsight, considering their candidates got pretty soundly beaten, generally speaking, in early November. So I think that loss really motivated Democrats to sort of put the differences aside and get the bipartisan deal passed, which actually happened in early November. That's almost certainly going to be signed by President Biden in the near future. So 1.2 trillion infrastructure deal, bipartisan deal, is now over the finish line. Worth noting on that deal, when we think about this stimulus versus previous stimulus, we're talking about a world of difference in terms of both overall spending and immediate spending. If you go back and look at CBO scores of the America Rescue Plan from March of 2021, Biden's first COVID relief stimulus, versus this bipartisan infrastructure deal, the timing of spending and the level of spending is very significantly different. So CBO scores from the America Rescue Plan had over $1 trillion in net spending in year one from the America Rescue Plan. By comparison, this deal is only 550 billion in new spending over 10 years. And the first year net spending might actually be negative because some of the spending in this bill of the 1.2 is actually taking away from previously passed spending measures. And so the timing of the spending and the significance of the fiscal hit from the bipartisan plan is significantly smaller than what we had seen in the beginning of the year. So keep that in mind as we think about the relationship between stimulus and consumer spending, the recovery, and what it ultimately means for inflation. Now, there's a second partisan deal that's also in the works. That deal is going through a CBO score now. Now that the bipartisan deal is passed, it might struggle in the Senate. We know that there are some middle ground Senate Democrats who are a little concerned about what's in that bill and how much spending is in there. And if we look at the CPI that we just got for October, showing its highest headline levels since 1990, I think some of those senators are going to be pretty concerned whether or not they're stoking more inflation by passing these bills. And so that bill always faced a harder battle than the bipartisan one. And the inflation numbers we've gotten recently, I think, only make that a little bit more difficult.
Okay, you kind of hit on something that I was starting to think about myself, which is, does this higher inflation outlook kind of kill this next bill? And I think that, getting the sense there that certainly from you, it's much harder. So any impact on markets from any of this? I mean, as you said, we need to think about it a little bit differently, or is this just not a major issue and we're all focused on the monetary policy side?
Well, look, I think right now we are in an inflation uncertainty driven environment, and everything really comes down to global supply shortages. We know demand is generally pretty strong, both in the US and globally, demand for goods, but we have these shortages, and to the extent that those shortages stay as a driver of higher inflation, that drives inflation uncertainty, it drives monetary policy uncertainty and interest rate volatility. And so we've been in this environment where inflation and by proxy monetary policy, dealing with or not dealing with that inflation, has really been the big driver of markets really over the past, let's call it 6 months, but especially over the last 1 or 2. The Biden administration, when they look at this new partisan bill, will say that this bill is probably the best thing you can do to alleviate those supply shortages. Because you take, for example, something like paid childcare. If you're thinking about labor market shortages, one of the arguments that Democrats are making is that labor shortages are partially because individuals who have children don't want to go back into the workforce because of childcare issues. There's probably shortages in childcare service providers, and the ability to fund that might have those people come back to work sooner. And so the Biden administration says, look, these bills will help alleviate these supply shortages. those on the other side basically say the net spending, the total net spending ends up being inflationary. So I think a lot of this really just comes down to, clearly there's a growth impact that comes from fiscal stimulus. The infrastructure plan is significantly smaller and it's not as near-term in scope as earlier stimulus. So I don't think we can apply the same playbook now. But I think we should look at these in the context of a shortage-fueled inflation uncertainty environment. And to the extent that that remains the overall driver, I think we're going to be looking at these packages as, are they inflationary or are they disinflationary? And what does it mean for the Fed? Does it mean the Fed has more confidence in growth and then can move interest rates higher sooner? Can they speed up the taper because they're more confident in growth? Or do they see these bills as inflationary and maybe come to the same conclusion, albeit for maybe what we call the wrong reasons?
All right. So just in the short minute that we have left, what about the long term? I mean, given the recent elections, you said, kind of I'll say it, Democrats kind of got underperformed significantly. Given the upcoming midterm elections next year, if over the long term is fiscal policy finished at it, whether whether we get this next partisan bill passed or not, is this the last chance?
I think this is probably the last major bill that we can expect from Biden's first term. Essentially, you look at the results. Now, the results from this year don't necessarily act as a precursor to guarantee anything for next year, but we've known for a while that the trend of the president's party to lose significant ground, especially in the House of Representatives in the following midterm, is already a very strong cemented pattern. And look, this is a pattern that has happened during expansions and recessions for Democratic presidents and Republican presidents. There is just a very strong snapback pattern. And I think it is related to motivation. Look, the losing party's voters are extra motivated, they're extra angry, and they go out to the polls and they vote in these elections that don't tend to draw as many voters simply because the president is not on the ballot. And so President Trump, if we look back at his 4 years, almost all of his major legislative achievements on specifically the tax bill were done in year one. Year two really was spent on the foreign policy angle. We all know the trade. The trade war was really the 2018 story. It was really his second year story. And when Republicans lost control of the House in the 2018 midterms, President Trump was effectively locked out of doing any major legislation, given the highly partisan nature of Trump versus the Democrats controlling the House. It looks like we might be setting up for something very similar. And, I mentioned a lot of reasons why the partisan plan might not be able to get done at the end of the day. But on the other side of that, this is a once in a presidential term opportunity to get this stimulus out the door, because the closer we get to the midterms, the harder it will be. And certainly, I think we should assume after early November elections that the base case should be that Republicans take back the House of Representatives, which again, that's the historical trend. Nothing we saw in early November elections would dissuade you from thinking that should be the base case. So Democrats, on one hand, they might be worried about inflation and what that means. But on the other hand, this is their opportunity. And so there might even be extra motivation to get something done. They might feel like they are more desperate for a win, having felt like they lost an opportunity and got pretty soundly beaten in elections in early November.
Okay. All right. Thanks, Brian, for all that. Hit a lot of different things there. So next week, we have employment data, inflation data in the UK, where I'm curious to see if we do get higher than expected inflation in the UK as well. If we're going to see yields continue to push to the new recent highs or even through them in both UK and US markets, and then also how that affects the currency. I mean, if you have both of those economies showing hot inflation, where does that fall out when it comes to like sterling and the dollar? But we also have some important consumption data of the U.S., inflation out of the Eurozone, though, Europe is in a much different spot regarding their central bank than others, so probably have less of an impact than, the impact we've seen in the U.S. and potentially the U.K. But that's all for this week. Thanks for listening, everyone. Thanks for joining, Brian, and have a good week.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.